Fair value gaps. Everyone's talking about them. You know why? Because they actually work. Even your waiter at the restaurant is talking about it now. Bro, have you tried fair value gaps? Yeah man, just draw boxes where there's space between candles. But here's the reality. Most people throw around the term without actually understanding which gaps work and which ones are complete traps. So today, I'm going to show you how to think like institutional traders when it comes to fair value gaps. We'll break down the real psychology behind these price imbalances, then I'll give you a powerful checklist to instantly know if a fair value gap is worth trading or not. Then go over some actual examples to see this strategy in action. And at the very end, I'll show a bonus tip that takes this entire approach to a completely different level. Let's get straight to it. What exactly is a fair value gap? Think of it as a price imbalance that occurs when the market moves with such aggressive momentum in one direction that it literally leaves behind an unfilled gap between candles. This gap represents an area where price didn't spend enough time, and here's the fascinating part. It often acts like a powerful magnet, pulling price back for a retest. Traders who understand this concept use these gaps to identify high probability entry zones with surgical precision. When you apply the right techniques, they can give you sniper level accuracy in your entries. Now, to spot a fair value gap, you need to start by looking for a sequence of 3 consecutive candles on your chart. You're specifically searching for a strong middle candle, one that clearly moves aggressively in one direction, sandwiched between 2 comparatively smaller candles. If the low of the first candle and the high of the third candle do not overlap with the middle candle's range, then a gap exists in the price action. That empty space between the first candle's low and the third candle's high is what we call the fair value gap. Once you identify it, draw a rectangle over that zone on your chart. That becomes your area of interest where the magic can happen. This concept works in both directions. In bullish setups, the gap is created as price pushes upward with strong momentum, while in bearish setups, the gap appears as price drops rapidly through the levels. Just remember, if there's no actual gap between the first and third candles, there's no valid fair value gap, no matter how large or impressive the middle candle appears to be. Now let's explore the theory behind fair value gaps and why they work so consistently across different markets and timeframes. Imagine this bullish candlestick sequence that created a significant imbalance occurred on a higher time frame like the 1 hour chart. To analyze this 3 candle sequence from the market structure perspective, let's zoom into a lower time frame like the 5-minute chart. Here we can see that price created a bullish structure with tremendous buying pressure. The market consistently shows a natural tendency to fill and rebalance the gaps present within its structure. Let me walk you through the psychology behind this phenomenon that drives these setups. As you can observe in this example, price created a successive bullish structure to the upside with tremendous momentum driven by high buying pressure and a notable lack of sellers in the market. When traders encounter such sharp movements and miss out on what could have been an excellent buying opportunity, they often place their buy limit orders below key zones such as order blocks and demand areas. They're hoping that price will make a pullback and activate their orders before resuming its upward movement. This scenario accumulates a substantial amount of pending buy orders in this area, creating a significant liquidity pool awaiting to be swept by the market inside the fair value gap. So here's what you need to understand about the mechanics. Fair value gaps are filled with numerous buy or sell orders, creating a substantial liquidity pool inside the gap. This is the primary reason why price is likely to return to fill these gaps and then continue its momentum with even greater strength than before. The presence of these pending orders within the fair value gap acts as a magnet for price, attracting it back to fill the void before resuming its trend. This creates incredible trading opportunities for those who know exactly what to look for and how to position themselves. Now let me share 5 practical techniques I use to filter out the noise and focus exclusively on the best setups that actually deliver results. Tip number 1 I want to show you involves understanding that some fair value gaps are significantly stronger than others and have much more priority in the market structure. An easy way to determine this is to mark fair value gaps by where they are positioned relative to the overall price movement on the chart. So here on this chart, we have multiple bullish fair value gaps scattered across different price levels. The lowest fair value gap will always be the strongest and have the highest priority, while the highest fair value gap will be the weakest and have the lowest priority. So in a perfect scenario, you should try to trade the lowest fair value gap possible for maximum effectiveness. The same principle applies to bearish fair value gaps in reverse. If you have multiple bearish FVGs on one chart, the highest fair value gap should have the most priority and offer the best risk to reward opportunity. For picking a fair value gap with the highest priority, what you want to do is go on TradingView and select the GAN box tool from the toolbar. Go to the settings and make sure the price levels are set to 0, 0.5, and 1. This will give you a visual framework that looks like what I'm showing you here. If you have multiple fair value gaps on a chart, just grab this tool and mark from the low of the entire move to the high of the entire move. This gives you an easy way to see which fair value gaps to prioritize for your trading. In a perfect scenario, you should not be trading any fair value gaps that are positioned in the upper portion of this tool. You want only to be trading gaps that are located in the lower portion of this framework. Same approach applies with short setups. Mark from the high of the move to the low of the move. You only want to be trading fair value gaps that are positioned in the upper portion of this tool. If you follow this step, you will only be trading high priority fair value gaps that have the best chance of working in your favor. Tip number 2 is that size matters in fair value gap analysis. Larger fair value gaps generally offer much stronger and more reliable setups. Why? Because a wider gap indicates a more aggressive imbalance between buyers and sellers, which makes it significantly more likely that price will revisit and react strongly from that zone. When you have multiple fair value gaps on the same chart, always prioritize the bigger ones over the smaller ones. The market respects larger imbalances more than minor gaps that can be easily filled without any meaningful reaction. Tip number 3 is to use only unmitigated gaps. The best fair value gaps are completely fresh, meaning price hasn't returned to test them yet since their formation. Once price comes back and touches the gap, that zone is considered mitigated and its edge weakens considerably. So if you spot a fair value gap that has already been retested, it's better to skip it entirely and wait for a fresh opportunity. Also, watch out for price that retraces too deep into the structure. If it closes inside or completely below the gap, the setup becomes invalid immediately. Ideally, you want price to tap the gap, respect it cleanly, and bounce with authority. Tip number 4 is watching out for fair value gaps that form near major support and resistance levels. Here's a common trap that catches many traders and destroys their accounts. You spot a beautiful fair value gap that looks perfect, but it forms right underneath a major resistance level that's been tested multiple times. That's a red flag you cannot ignore under any circumstances. Why? Because price may reach that resistance, reject hard, and completely invalidate your fair value gap setup. It's always smart to check your surroundings and understand the bigger picture. Avoid fair value gaps that appear too close to obvious barriers like major support and resistance levels, psychological numbers, or previous significant highs and lows. The 5th and final tip is to focus specifically on fair value gaps that form right after a break of structure occurs in the market. Some of the most reliable and profitable fair value gaps form immediately after a break of structure takes place. When price breaks a key level and immediately leaves behind a fair value gap in its wake, that zone becomes a high probability area for smart money to re-enter the market. The first retest of this fair value gap often triggers a powerful reaction that can deliver exceptional risk to reward ratios for position traders. Let's put our knowledge to the test. Take a look at this chart example. We have price creating what looks like a fair value gap right here. But here's my question for you. Would you trade this gap or not? If you said, no, I wouldn't trade it because there's no break of structure, you're absolutely right. This gap doesn't qualify because price failed to break the previous high. But what if we had a scenario like this instead? Price breaks above the previous high and creates a fair value gap in the process. This gap becomes valid because we have that crucial break of structure confirming the move. Here's another scenario for you to analyze. Check out this fair value gap that looks absolutely perfect at first glance. It's large, it formed after a break of structure, and it's unmitigated. Now the big question, would you take this trade or pass on it? If you said pass on it, you're thinking like a pro. Even though the gap checks most of our boxes, that resistance level is a major red flag. Price could hit that resistance, get rejected hard, and completely invalidate our setup. And now here's the complete strategy that pulls all these concepts together into a systematic approach. We'll use 2 different time frames for this strategy to get the complete picture of what the market is actually doing. On the higher time frame, we analyze market structure to determine the overall market direction and ensure we're trading along with the dominant trend. This includes marking breaks of structure and changes in character. Then we highlight the fair value gaps, which serve as our optimal trading zones where we expect the highest probability reactions. Next, we zoom into the lower time frame to find the precise entry trigger, which is typically a liquidity grab that confirms the market's intentions. Once we spot this confirmation, we simply enter the trade and set our targets based on the next logical levels. Now, why does this strategy work so consistently across different market conditions? By combining these 3 powerful concepts, you ensure that you are trading with the prevailing trend, entering at key supply and demand zones, and gaining extra confirmation from lower time frame patterns before risking your capital. Let me quickly break down the key concepts that make up this comprehensive strategy so you understand exactly what we're looking for. The BOS, break of structure, happens when price breaks through recent significant highs or lows with conviction. A bullish BOS indicates strong bullish momentum and suggests a possible continuation to the upside. On the other hand, a bearish BOS signals powerful bearish momentum and suggests a possible continuation to the downside. Next, we have the change of character, or chalk. A typical bullish chalk happens when price first breaks a recent low, creating a bearish BOS, and then immediately breaks the swing high that led to that BOS. This forms a regular chalk and can indicate a possible reversal to the upside is developing. Similarly, a bearish chalk occurs when price first breaks a recent high, creating a bullish BOS, and then quickly breaks the swing low that led to that BOS. This signals a potential reversal to the downside is in progress. When the market forms a lower high before breaking the bullish structure, we have what's called a chalk plus, which means it is a stronger or more confirmed change of character and can be a much better signal for a potential reversal. Next, we incorporate the fair value gaps we've been discussing. As we said before, we will use these gaps as key areas of interest, where we expect possible price reactions and optimal entry opportunities. Finally, we have liquidity grabs. Liquidity refers to areas on the chart where there are clusters of pending orders, mainly stop losses. These zones are like magnets for smart money. When you and I want to enter a position, we can pretty much enter whenever we want. Since we're not dealing with hundreds of millions of dollars, there will always be enough counterparties to fill our orders at the price we want. So here's where big banks and hedge funds face a completely different challenge. These institutions are dealing with such massive amounts of money that they can't trade like normal people. So what do? They create the sellers themselves. They manipulate price to areas where they know retail traders have placed their stop losses, forcing those traders to become unwilling sellers at exactly the prices the institutions want to buy. This is why you see those frustrating scenarios where price hits your stop loss by just a few pips and then immediately reverses in your intended direction. It's not bad luck, it's calculated liquidity hunting by smart money players who need your forced selling to fill their massive buy orders. Now let me show you exactly how this trading strategy works on actual charts with real examples. This trading strategy uses 2 specific time frames for maximum effectiveness. My suggested combination is the 1 hour and 5 minute time frames, but you can adapt it to other time frames as well. Just remember your entry time frame should be at least 2 times lower than your analysis time frame for proper perspective. On the higher time frame, the first step is to identify the overall market direction with precision. You can do this by identifying market structure concepts clearly. For example, if price keeps making higher highs and higher lows while breaking the previous market structure, this shows a clear uptrend and we remain bullish until we get a definitive change of character. After finding the direction, the next step is to mark the fair value gap areas that align with our directional bias. On the higher time frame, these gaps are significantly more powerful and can act as strong support or resistance levels that institutions respect. Once you mark these fair value gaps, wait for price to pull back into one of them. When price enters the gap zone, switch to the lower time frame to look for your specific entry trigger. On the lower time frame, you want to see clear signs of a possible reversal developing. One strong signal is a bullish liquidity grab, which happens when price moves below a recent low, takes out retail stop losses, and then quickly reverses upward with conviction. If this move also breaks a short-term bearish structure on the lower time frame, it gives you additional confirmation. In other words, it forms a change of character that validates your entry. Finally, it's time to open the trade with proper risk management. You can place your stop loss just below the low of the liquidity grab, and your target can be the next important level in front of price on the higher time frame. In the bearish case, start on the higher time frame by confirming a clear downtrend with lower lows and lower highs. Then mark the fair value gaps as possible supply zones where selling pressure may emerge. When price pulls back into one of those gaps, switch to the lower time frame and look for a bearish liquidity grab above a recent high. Enter the trade only after proper confirmation appears. Place your stop loss just above the liquidity grab and aim for the next key level below on your higher time frame analysis. Now, here's the special tip I promised you that can make this entire process much more efficient. If this practice feels unintuitive, and even after mastering this concept, you may find it tedious to manually mark each structure on your chart, fortunately, there is a powerful indicator on TradingView that can automate this process for you. From the Indicators tab, type Price Action Toolkit and click on the indicator provided by FluxCharts. Once you open the Settings tab, you will see many options to apply to the chart. But for now, let's just mark the BOS, Chalk, and Chalk Plus in the Market Structure section to get these automatically identified. Next, we have the Fair Value Gaps section. If you enable this option in the indicator settings, they will appear automatically on the chart without any manual work required. In the Settings tab, increasing the sensitivity removes smaller gaps and only shows the larger, more significant ones that are worth your attention. Finally, we have the Liquidity Grabs feature. When you apply it to the chart, you'll notice red and green circles appearing at key levels. These represent bearish and bullish liquidity grabs respectively. When price wicks above a previous swing high, the indicator identifies it as a bearish liquidity grab, signaling a potential downward movement is developing. Similarly, when price wicks below a previous swing low, it is marked as a bullish liquidity grab, indicating a possible upward move is in progress. If you decrease the pivot length and wick body ratio in the settings, the indicator identifies more liquidity grabs because it becomes more sensitive to market movements. This means it will catch smaller wicks and more price movements that could be signs of liquidity being taken by institutional players. Now let me show you how this complete strategy works on actual charts, with the indicator helping us identify these setups automatically. On the higher time frame, the first step is to identify the market direction using the structural analysis we discussed. In this case, the indicator labels show that price keeps making higher highs and higher lows, breaking the previous market structure consistently. This shows a clear uptrend, and we remain bullish until we get a definitive change of character. After finding the direction, the next step is to locate the fair value gap areas that align with our bias. On the higher time frame, these gaps are more powerful and can act as strong support or resistance levels that smart money respects. The indicator will mark these fair value gaps for us automatically, and we wait patiently for price to pull back into one of them. When price enters the gap zone, switch immediately to the lower time frame to look for your entry confirmation. On the lower time frame, you want to see signs of a possible reversal that validates your higher time frame analysis. One strong signal is a bullish liquidity grab, and the indicator marks it for us automatically with clear visual signals. Finally, it's time to open the trade with confidence. You can place your stop loss below the low of the liquidity grab, and your target can be the next important level in front of price on the higher time frame. In the bearish case, start on the higher time frame by confirming a downtrend with lower lows and lower highs clearly marked by the indicator. Then identify the fair value gaps as possible supply zones where selling pressure may emerge. When price pulls back into one of those gaps, switch to the lower time frame and look for a bearish liquidity grab above a recent high. Enter the trade after receiving proper confirmation from the lower time frame structure. Place your stop loss above the liquidity grab and aim for the next key level below based on your higher time frame analysis. The liquidity grab feature alone is actually available for free on Flux charts. However, if you want to unlock the full potential with all the advanced features, including volumetric order blocks, enhanced fair value gaps, and comprehensive market structure analysis, I negotiated the best discount ever for our community to have the complete price action toolkit with 20% off through the link in the description using this code. I do earn a commission when you use my link, which helps me continue creating free educational content like this video. But here's the thing, this indicator is genuinely valuable and something I would recommend even without any sponsorship. Thanks for watching and see you guys next time.